Have you ever wondered why even really smart people, people with seemingly foolproof plans, sometimes just lose catastrophic amounts of money in the financial world?
It's a great question. Happens surprisingly often.
It really does. It can be
Yeah.
genuinely perplexing. So, here on the deep dive, our whole mission is, well, to be your shortcut. We want to help you understand these complex topics.
Turning dense research into insights you can actually use.
Exactly. And today, we're taking a deep dive into this really intriguing paper. It's called How to Lose Money in Derivatives. Examples from hedge funds and bank trading.
Quite a title.
It is. Our job here is to pull out the most important nuggets of knowledge from it, help you understand the common pitfalls, the, surprising realities behind some major financial disasters.
And what's fascinating, I think, is that while derivatives can seem incredibly opaque, maybe complex,
Definitely complex.
yeah, the core reasons for failure, they're often quite simple and strikingly repetitive. We're looking for patterns here, not just, isolated blow-up.
Patterns. Okay.
Because understanding how people lose money, maybe counterintuitively, is probably the best way to figure out how to avoid losing it yourself.
Okay, so let's unpack that. The paper seems to identify a clear recipe, almost, for financial disaster, especially with these futures hedge funds. It boils down to just a few core ingredients.
That's right. The common threads are almost always there. Overbetting is a big one. Meaning taking positions that are just far too large relative to your capital and, crucially, relative to how volatile the thing you're trading actually is.
Got it. Too big for your boots, essentially.
Sort of, yeah. And that's coupled with a critical lack of diversification, especially, and this is key, diversification that holds up in adverse scenarios, when things go wrong.
So not just diversified when markets are calm.
Exactly. And what's more, when trouble does hit, you often see managers, well, they double down on the losing bets. They're hoping for a market turnaround instead of just cutting their losses, protecting capital.
And you mentioned this before we started. The paper suggests the incentive structure plays a huge role here, too. That's really interesting.
Oh, absolutely. Think about it. Managers often get these huge fees on gains, right? Maybe 20% of the profit.
The classic 2 and 20.
Precisely. But the penalties for losses, often minimal, beyond maybe losing their own investment in the fund, if they have one, their downside is capped, personally.
But the upside isn't.
Exactly. That asymmetry, well, it can push people into taking incredibly risky, sometimes even reckless bets, because the personal upside is potentially huge, while the personal downside, less so. It creates this powerful drive for outsized returns, sometimes, at almost any cost to the fund itself.
Okay, so those are the core ingredients.
Yeah.
Overbetting, flawed diversification, doubling down, and these skewed incentives. Now let's dig into the specific ways the paper says these losses happen. The pathways to ruin. What's a major one?
Well, one of the big ones is just pure speculation. Now, derivatives, fundamentally, they're designed for risk transfer. You have hedgers who want to offload risk, and speculators who are willing to take it on, hoping to profit.
Okay.
But when speculators take what are called naked, unhedged positions, that's just the purest form of a bet, and it's amplified, often massively, by leverage.
Can you give an example?
The classic one is Nick Leeson at Barings Bank. He was betting heavily using options, specifically short puts and calls on the Nikkei index.
Selling options, right, which is like selling insurance.
Exactly. He was selling insurance against big market moves, up or down, betting the market would stay pretty calm. He collected the premiums.
Seemed safe, maybe, if the market cooperated.
Until it didn't. The Kobe earthquake hit Japan in 1995. Massive, unexpected event. The market went wild.
Wow.
And suddenly, Leeson owed huge amounts on all that insurance he'd sold, both the puts and the calls. It bankrupted a centuries-old bank.
Wow. And the paper links this to something called human agency problems.
Yes, that often ties in. It's where traders, maybe facing losses that could cost them their job or bonus, start acting against the firm's best interest. They double down, hide losses, take even bigger risks, hoping to recoup. Their personal incentives diverge from the firm's.
Right. Trying to save their own skin, essentially.
Pretty much.
Okay, so that's speculation in agency problems. Another one you mentioned that sounds subtle but dangerous is misunderstanding risk exposure.
Yes, this is crucial. As these financial instruments get more and more complex, truly grasping their full risk profile, all the nuances, it becomes incredibly difficult, even for the experts.
Why is that? Are the models just not good enough?
Well, that brings up a really important point. What happens when your risk models, like the very widely used value at risk, or VAR, what happens when they fail?
VAR. Remind us what that is.
Sure. VAR basically tries to estimate the maximum loss you might expect over a certain period with a certain confidence level. Like, say, 99% confidence you won't lose more than X amount tomorrow.
Okay. Sounds useful.
It can be, but the models often assume market movements follow a nice, predictable bell curve, a normal distribution. The paper points out that investors, or their models, often assume those really extreme scenarios, the outlier events, the fat tails, as they're sometimes called.
The things way out on the edges of the bell curve.
Right. They assume those have basically zero probability.
Yeah.
But the reality is they have low, but definitely positive probabilities. They can happen.
The black swan events.
Exactly. And when one of those hits, your standard VAR model just doesn't capture the true potential loss. It breaks down.
So what's the alternative?
The paper strongly suggests you need scenario-dependent correlation matrices. That's a mouthful, but
Break it down for us.
it means you can't just rely on how assets move together historically, especially in calm markets, because in a crisis, correlations change drastically. Things you thought were uncorrelated suddenly all move down together.
So your diversification vanishes just when you need it most.
Precisely. You need models that explicitly consider how things behave in specific stress scenarios, not just based on average past behavior.
Okay, that makes sense. Models fail, understanding is hard. But underlying all of this, it feels like the big one, the common denominator, is still overbetting. Is that fair?
That's absolutely fair. The paper is pretty explicit. Nearly all the major failures involve overbetting. It's just so easy to do with derivatives because the leverage is inherent and the size of your position can balloon rapidly if market volatility changes.
What seems manageable one day
can become dangerously large the next without you even placing a new trade just because the market got chalky. It requires constant vigilance and, frankly, discipline.
Okay, let's make this really concrete. Let's talk about long-term capital management. LTCM. The year is 1998. The financial world is watching, stunned, as this hedge fund just implodes.
Right, and this wasn't just any fund. It was legendary, packed with academic superstars, including two guys who would later win the Nobel Prize in Economics, Myron Scholes and Robert Merton. Seriously, Nobel laureates. They were literally dubbed too smart to lose.
That was the reputation. They were the best and the brightest.
So what was their supposedly genius strategy?
Their main thing was bond risk arbitrage. Basically, finding tiny price differences between similar bonds around the world. Maybe one seemed slightly underpriced, another slightly overpriced, relative to where theory said they should be.
And they bet those prices would converge.
Exactly. They believe strongly in efficient markets, that prices would eventually revert to their correct values. They use complex mathematical models, assuming things followed smooth, predictable patterns, those log normal assumptions again.
Okay.
And because the price differences were tiny, they needed huge amounts of leverage to make meaningful profits. They started with about $4 billion in equity, their own capital.
Which is a lot.
It is. But their positions, the total notional value, the face value of the contracts they held, was estimated around $1.25 trillion.
Wait, trillion with a T. Trillion with a T. The leverage was staggering. Something like 30 to 1, maybe more, depending on how you calculate it. They believed these trades were almost riskless because they were hedged, betting on convergence.
And for a few years, it worked incredibly well, didn't it? Huge returns.
Phenomenal returns, attracted massive investments. But then they made a really interesting move. They actually returned about $2.7 billion to their investors in late 1997.
Why would they do that? Give money back.
To concentrate the remaining capital, boost the returns on the smaller base, and then the partners themselves took out personal bank loans around $100 million and put that back into the fund. The paper calls it greediness, wanting even higher returns on a smaller capital pool, magnifying their personal stakes.
Doubling down personally.
Risky.
Very. And then came the trigger. August 1998. Russia devalued the ruble and defaulted on its government bonds.
The Russian crisis. I remember that. It sent shockwaves globally, a crisis of confidence, as the paper calls it. Investors fled to safety, liquidity dried up, and those tiny bond spreads LTCM was betting on. They didn't converge. They widened dramatically.
So their core assumption failed.
Utterly. And their supposed diversification, it evaporated.
Yeah.
In a crisis, everything correlated. They lost about 95% of their capital, roughly $4.6 billion gone in just a few weeks. The Fed had to orchestrate a bailout by major banks to prevent systemic collapse.
Just incredible. So the lessons from LTCM seem pretty stark then.
Absolutely stark. First, obviously, don't overbet. leverage kills. Second, VAR systems. Clearly inadequate for these kinds of tail risks. They just didn't see it coming.
Need those scenario-dependent models.
You really, really do.
Sure.
Third, historical correlations are a trap in a crisis. Fourth, you have to allow for illiquidity markets can freeze up, and for defaults, even sovereign defaults.
And finally,
true diversification matters. The paper contrasts LTCM with George Soros' quantum fund around the same time. Soros also had Russian exposure, maybe 10% of his fund. He lost that. But because the rest of his portfolio was genuinely diversified across different strategies and regions, the fund was still up something like 21% overall that year. LTCM was wiped out. Soros took a hit but survived comfortably. That's the difference.
wow. Okay, let's switch gears to another fascinating, maybe cautionary tale. Victor Niederhofer.
Niederhofer, a truly brilliant, multi-talented guy. Top squash player, chess whiz.
Renaissance man.
Yeah, and a very successful commodities trader for about 15 years. Averaged something like 35% net returns annually. Very impressive. Even George Soros trusted him with a $100 million account to manage at one point.
High praise. But his story also involves a blow-up.
A big one. In 1997, his fund completely imploded. He'd made a large bet on supposedly cheap stocks in Thailand.
Uh-oh. Thailand, 1997. That sounds familiar.
Right, the beginning of the Asian financial crisis.
Yeah.
Those stocks just kept getting cheaper. And then he combined that with a massive short position in out-of-the-money S&P 500 futures index puts.
Selling puts again. Like Leeson selling insurance against a crash.
Exactly, a huge amount of it. Then the Asian crisis spread, spooked global markets, and triggered a sharp, fear-driven drop even in the U.S. stock market. Volatility exploded.
So those puts he sold.
Became incredibly valuable. Puts
Okay.
he'd sold for maybe $4 or $6 each surged to $16. He faced massive margin calls. His $70 million fund didn't just go to zero, it went negative. About minus $20 million. Wiped out.
Ouch. He had that quote, though, right?
So-
Something about mastering disaster.
He did. He famously said later, "The best way to achieve victory is to master all the rules for disaster and then concentrate on avoiding them."
So did he learn? He started over, right?
With new funds.
He did. He launched the Matador and Manchester funds, claimed he'd learned his lesson, said he'd stick to what he knew, focus on liquidity, prepare for extreme events, and for a while, he did phenomenally well again, even ranked #1 among hedge funds for a period.
The phoenix rising from the ashes.
It seemed like it.
Yeah.
But did he truly learn? The paper points out that his own fund literature for Manchester explicitly stated they choose not to diversify.
Really, after everything. Apparently. And then, in mid-2006, there was another market dip. Not even a crash, really. The S&P 500 fell about 7%.
Okay, a correction.
Just a correction. But Niederhofer's funds, catastrophic losses again. Matador lost 67%. Manchester lost 45%.
From a 7% market drop? How?
Massive leverage again. His positions were structured such that a modest market move was magnified tenfold or more in his funds. The paper sort of dryly concludes he was back in business once again, perhaps till the next time.
Wow. So even brilliance in experiencing disaster firsthand doesn't inoculate you against overbetting and ignoring diversification.
It seems not. It really highlights the psychological pull of high returns and maybe overconfidence in one's own abilities, even after being burned badly before.
These stories are compelling. It really does make you wonder about that human element, doesn't it? Like, why double down when things are clearly going wrong?
It's a deep question. Maybe ego. Maybe the incentive structure again. Maybe just hoping against hope. But it's a recurring theme.
Okay, one more case study. Amaranth Advisors. This one was huge too, right? A massive loss in a very short time.
Huge. Amaranth lost a shocking $6 billion. That was about 2/3 of their entire fund in less than 2 weeks in September 2006.
$6 billion.
How? Primarily due to enormous concentrated bets in the natural gas futures market.
Natural gas. Okay.
This case, according to the paper, just perfectly illustrates that three-part recipe for disaster we talked about earlier.
Remind us.
1. A trader overbets relative to the fund's capital and the volatility of the market. 2. The portfolio isn't truly diversified against plausible negative scenarios. And 3. One of those negative plausible scenarios actually happened.
And Amaranth checked all those boxes.
Clearly. The trader involved, Brian Hunter, had actually made huge successful bets on natural gas the previous year in 2005. Big wins.
Success breeds complacency.
It seems so. The paper suggests this led to relaxed risk controls. Hunter's natural gas trades eventually accounted for something like 58% of the entire fund's assets. And on a risk-adjusted basis, Maybe 70 to 90% of the fund's risk was tied up in these bets.
Wow, almost all their eggs in one basket. What was the specific bet?
He was betting heavily with about 8-to-1 leverage that the spread between natural gas prices for delivery in different months would widen. He thought winter prices would rise much more than near-term prices. It narrowed instead. Prices started dropping overall, partly due to forecasts of mild weather and reports of high natural gas storage levels.
So his bet was going wrong. What did Hunter do?
He responded by increasing his bets, doubling down exactly the behavior the paper warns against, trying to force the market or just digging a deeper hole.
And the losses mounted rapidly.
Exponentially, given the leverage. What's also fascinating, and maybe a bit cynical, is how others profited massively from Amaranth's collapse.
How so?
As Amaranth was forced to liquidate its massive positions in a hurry, other players, big banks like JP Morgan, other hedge funds like Citadel, were on the other side. They were able to take over Amaranth's losing positions at huge discounts.
One fund's disaster is another's opportunity.
Often, yes. Amaranth's overbetting essentially created a forced sale that benefited others.
The paper makes that provocative point you mentioned earlier, that rogue traders are grown in particular organizations. What kind of environment allows this?
It points towards cultures where maybe risk controls get sidelined after big successes, where perhaps one star trader is given too much autonomy, too much capital, without enough independent oversight, where the focus is just relentlessly on returns without fully appreciating the risks being taken to achieve them.
And it wasn't just Amaranth itself, right? Other sophisticated investors lost money too.
Absolutely. Even large funds entities that are supposed to be experts at vetting and diversifying across different hedge funds had significant stakes in Amaranth and lost badly. It shows how hard due diligence can be and how risk can hide even from supposed experts.
Okay, so we've heard these incredible stories. LTCM, Niederhofer, Amaranth. What does this all mean for you, the listener, whether you're managing a portfolio, maybe making big decisions in your own business or life, or just trying to make sense of the financial news?
I think the overarching lesson, the one that just screams from all these examples, is that overbetting is the primary driver of catastrophic loss. It's the original sin, if you will.
More important than getting the direction wrong.
In terms of sheer disaster, yes. You can be wrong small. Overbetting means being wrong big. The paper mentions the Kelly criterion, a mathematical concept about optimal bet sizing for long-term growth. It basically shows that betting more than the optimal amount doesn't just increase risk, it actually lowers your expected long-term growth rate.
So betting too big is actually counterproductive, even if you have an edge.
Exactly. It eventually leads to ruin. It's like trying to drive faster by pushing the accelerator through the floor. You might go faster for a bit, but you're far more likely to crash and never reach your destination.
And the second big takeaway.
True diversification. The paper hammers this home. It has to be diversification that holds up under stress in those extreme scenarios, not just diversification on paper in calm markets.
So thinking about how correlations change in a crisis.
Absolutely. Relying on historical data alone is dangerous because, as we saw with LTCM, correlations often go towards one. Everything moves together precisely when you need diversification the most. You need to stress test for that.
And what about the human side, the incentives?
That's critical too. We need to be aware of how incentive structures, whether for fund managers or even within companies, can drive behavior. That misalignment between personal gain and the firm's or investor's best interests is a recurring theme in these blowups. How much is driven by a genuine belief in the trade, and how much by the lure of a huge bonus? It's hard to untangle.
It makes the comparison to someone like Warren Buffett really stand out, doesn't it?
It really does. The paper notes Buffett's genius isn't just picking winners, it's that when he takes risks, even big ones where he sees a substantial edge, they are always a tiny fraction of Berkshire Hathaway's total capital.
He doesn't bet the farm.
Never. And he always maintains massive cash reserves, billions. That allows Berkshire to withstand any storm, any market panic, and also gives them the firepower to seize opportunities when others are forced sellers, like the banks buying Amaranth's positions.
It's a fundamentally different philosophy. Less about complex models, more about prudence and margin of safety.
Exactly. Resilience over intricate optimization that might be fragile.
So wrapping this up, our deep dive today has really shown that while the instruments, the derivatives, can seem incredibly complex,
the reasons for failure are often surprisingly simple and depressingly human. Hubris, misjudging risk, forgetting true diversification.
And that big one, plain old overbetting.
Right. And it's fitting that the paper ends with that quote from Victor Niederhofer, the guy who blew up twice. The best way to achieve victory is to master all the rules for disaster and then concentrate on avoiding them.
Easier said than done, perhaps.
Perhaps.
So, for you, the listener, maybe here's a final thought to chew on. If even the absolute smartest minds, people with Nobel Prizes and incredible track records, repeatedly fall victim to these fundamental mistakes, what does that tell us about human nature, about managing risk, not just in finance, but in any complex part of our lives? How can you apply these lessons thinking about bet sizing, about true diversification against things going wrong, about understanding incentives not just to your money, but maybe to your career decisions, your big projects, or even just navigating daily life? Something to think about.